Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, December 27th, 2023. As always, we'll start with our executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to do about them in your portfolio, you need to be a client at 42 Macro. So number one, after declining from mid-April to late October, global liquidity, as measured by the 42 Macro Global Liquidity Proxy, continues to trend higher, supporting asset prices in the process. We unpack the positive uptrend in global liquidity in our November 21st leadoff morning note and supplemented that with a deep dive on the fixed income and currency market drivers of the uptrend in our November 22nd leadoff morning note. Those drivers continue to support our expectation for rising global liquidity over the medium term. Number two, also contributing to the uptrend in global liquidity is the low net bond supply financing regime by the U.S. Treasury Department, which we flagged in real time in late October and early November as an upside risk for asset markets in Q4. And lastly, number three, all told, investors that do not have the data, the quantitative tools, and or the daily discipline to track trends and inflections in global liquidity in real time will continue to lose money on the other side of trades of investors that do possess those things. And obviously, we have plenty of data as evidenced by our global liquidity proxy, which is the global central bank balance sheets plus global broad money supply plus global FX reserves minus gold. We also have our 42 macro net liquidity model, which everyone knows that's the Fed assets, total assets divided by or minus the TGA and RRP balances. We also have our macro weather model, which helps us track trends and project excess return dispersion as a function of those trends in liquidity for both U.S. dollar liquidity here domestically and also global liquidity. And obviously we have the daily discipline, executing and refreshing all the same quantitative risk management tools and hammering our Bayesian research, qualitative research process 6 days a week, sometimes 7 when we have our macro scouting report. So one thing that's very differentiated from about 42 macro that I think our clients have learned to appreciate because it's making them money in asset markets when there's money to be made, i.e. 2023. And it's also helping them save money in asset markets when there's money to be saved, i.e. 2022. The reason we continue to have those differentiated results is because of our differentiated process. We don't do investing like everyone else on finance Twitter or everyone else on the podcast do it. We do investing like the top end of institutional clients do it in terms of the folks that I've been meeting with for 15 years on Global Wall Street, taking the best of in terms of elements of their various processes and practices and fusing that into our research process here at 42 Macro. So we're proud of what we do. It's working, and we're going to continue to execute the process heading into 2024. Transitioning into our my 42 Macro dashboard. Nothing's overbought, oversold from the perspective of the key trading ranges. So we'll just leave you with some levels for the Nasdaq here. We'll switch it up a little bit for those who like to trade the Qs instead of the SPUs. So we got a downside to about 416, 432. And an upside to about 17 for 17. When we call, we call for the pain trade here on November 1st. Where's November 1st? November 1st. Call for the pain trade higher here. We went into a bullish. The global liquidity inflected higher here on November 21st, and then we pivoted to a Goldilocks top-down market regime here on November 21st. So you have 1, 2, 3 opportunities to make. To change your positioning as a bear in response to 42 macro signals in order to right-size your portfolio for this trend higher, which may be the beginning of something that could persist. If soft landing continues to rise in probability, and what I mean by rise in probability is not necessarily that the actual probability of a soft landing goes up empirically or economically, but that it rises in probability by taking share amongst market participants' expectations from the no landing and hard landing camps. If we continue to see the no landing camps shrink in size and the hard landing camps shrink in size, the people with those positions on will have to chase the soft landing Goldilocks trade that we called for in real time and ultimately continue to benefit in terms of our positioning. That doesn't mean a soft landing is the highest probability outcome, or I do believe soft landing is the highest probability outcome, but it doesn't necessarily mean it has to be the outcome. Again, we need to be landing agnostic here if we want to make and save money in asset markets. You don't need to predict the outcome. You need to make money while the market is deciding what the outcome is likely to be. That is what your job is as an investor. Your job isn't to stick the landing. It's to actually make money and save money in financial markets. And I think we're doing a great job of that because we understand that distinction. Transitioning to our 42 macro aware community. We got a question here from a subscriber says, "Hey, Derry, do you have any idea why BITO, which is a Bitcoin futures ETF, has diverged negatively almost 20% from Bitcoin recently. So two things I'll say about this. One, that statement is patently false. My friend, not to harp on you, but I went and looked at the performance of the BITO ETF relative to Bitcoin, and if you look at it on a 1 5 day basis, the BITO ETF, which obviously hasn't really repriced yet, or BITO ETF is up about 1% on a 5 day basis. Bitcoin itself, the token, is down about minus 1.8% on a 5 day basis. On a 1 month basis, BITO, the ETF, is up 15%. On a 1 month basis, Bitcoin itself is up 16%, so right in line there. And then over the last 3 months, BITO is up about 57%, whereas the token itself is up about 63%. So there's really not much divergence at all in the path of these assets. So I don't know that I agree with the premise of I do not agree with the premise of the question. I reject the premise of the question. But one thing I will say, just in terms of a teaching moment here, you should not expect exchange traded products, whether they be ETFs, which is obviously everyone's waiting on in terms of the Bitcoin, whether they be exchange traded notes, which is what this is in terms of the futures. You should not expect exchange traded products to perfectly track the underlying asset or the underlying index. There's always tracking error as a function of flows into and out of those products. And more importantly, it's just tracking error, just generally speaking, unless you're specifically long that particular item, there's obviously going to be tracking error. And obviously with any index, it's pretty easy to have tracking error anyway. So I'll just say, when you're long an exposure, you need to understand how the exposure trades, how the exposure has historically behaved, what's the tracking error. And ultimately, it's your job as an investor to respond to our signals and put yourself in the proper instruments that might be better for you. Obviously, we're trying to produce, generalized research for, thousands of investors across the world that have different, liquidity preferences, risk tolerances, obviously different functions. Some, very top end institutional money managers, others, in retirees, people in retirement, or, young crypto kids. We service the investment needs of a variety of investors. So at the end of the day, our research has to be general in nature and not too specific in terms of what might be work specifically for you, the end user. So there's obviously some you obviously need to do a little bit of work to make sure your 42 macro signals, you're appropriately implementing 42 macro signals as it relates to your needs as an investor. So we appreciate that. Appreciate you. And we'll catch you back here tomorrow, same day. Hope everyone's enjoying a happy and wonderful holiday season. Cheers.